but I just wanted to share with you what I do for people that are struggling with their student loans. I call this how to leverage $1.5 trillion of student loan debt into a cash value life insurance policy. Now, who are the people we're looking for? Well, these are people that cannot move out of their own home. Maybe they still live with their parents in their 30s. They can't get married because no one's going to want to marry into all that debt. Maybe they want to have more kids, but they can't afford it.
This is what you should be paying.
Or a business owner that cannot move to the next level because their cash flow is tied up in their student loans. And the reason they're frustrated with all of this is because they're functioning from the old way of repaying student loans, the traditional repayment options. So there's the standard repayment of 10 years, and most people think this is the cheapest route. I am going to prove that wrong. There's a graduated repayment, which is just a variation of that, and then there's the extended repayment. The extended repayment plan, this is the worst one because it's like a mortgage on your student loans, and the longer you repay a loan, the more you pay. This is the most expensive option out there. The bottom line is that you pay the balance off in full. Now, this is how student loan repayment has always been done, and they're still teaching it today. I pulled this off CNBC. This published this a month ago. They're still talking about paying down student loans, and they're also saying how it's competing with saving for retirement. Well, by the end of this webinar, you're going to see that you don't have to pay down your student loans, and you can save your retirement at the same time. In fact, we're going to leverage your student loans to fund your retirement. Now, how is this all possible? Well, the thing is, these old programs are outdated and they need replacement, just like these old life insurance policies without living benefits. So what's the equivalent here? Well, student loan forgiveness programs. These were passed through legislation back in 1993, the Omnibus Budget Reconciliation Act, and further updated by executive orders in 2011 and 2014, and they gave birth to what is called income-driven repayment. And there's 5 different plans. They're based on your income. The repayment plan is based on your income, your family size, and your state of residence. Your payments can be $0 a month. That is different from missing a payment for 2 years. Your payment is actually 0, and you're not mailing in a pay stub with 0. You're just not having to pay for that month, for that year. And the way you want to play this right is you want your balance to be forgiven after time. So I want you to ask yourself, if you knew your loan would be forgiven, would you want to pay as much as you can or pay as little as legally possible? So this is what I've been doing for the last 10 years for student loan forgiveness. I have a company, College Loan Angel, where I help borrowers get student loans forgiven properly. That's the most important part, properly. Why work with me? Well, I find the correct repayment plan based on the client's situation and include a synergistic strategy which leverages cash value life insurance to get them the absolute lowest payment overall. I apply the law, find the best plan, and create a personalized strategy so they can do something smarter with their money. Now, why doesn't everyone choose student loan forgiveness? Well, they don't know it exists, or they're just misinformed, confused, maybe it's too difficult, or some people actually think it's a scam. Like these people were confused. This guy was paying into his loan for 8 years. I mean, yes, it's good he was paying his loan for 8 years, but he thought that 8 years would count for time towards the 20 years. It did not. He's just going to pay the whole thing off at this point. This next person, so this title is wrong. This is how little the public knows about it. Borrowers do not have to start over on their loans. What I wanted to point out here was bullet point number 2, that more than 30% of people who file a certification form are denied. This happens because they disqualify themselves from these programs, not because they make too much money, that could be part of it, but because they made enough money and did not properly adjust downwards their gross income. That's one of the other strategies I employ when doing this. But I would say the most dangerous thing that people are misinformed about or just don't know is that these loans just don't vanish after 20 years. You're not completely off the hook. It sounds like it when you hear the word forgiveness, but it's actually student loan forgiveness. Sorry, Elke, I know you don't like this picture. So what that means is the forgiven debt is taxable as income. Have you heard of the 1099-C? What that means is the real cost includes taxes on these forgiven student loans, and these loan balances are growing for 20 to 25 years. All of the details can be found in Internal Revenue Code section 108. I'm not a tax attorney, I'm just stating some facts. So let me give you an example of how this would work and how it worked for one of my clients. This person is a travel industry employee. If he followed the standard plan, so he had about $80,000 borrowed, and he was scheduled in 10 years to pay it off, including interest of $100,709. And that's $955 a month for 10 years. Now, when we employ a strategy and the right plan, instead of $100,000, he's only paying $2,225 into the debt over 20 years, not 10, at an average of $9.50 per month. And again, with that 1099-C, his loan grew to about $200,000. So we're calculating taxes to be $53,000, $54,000. His total payments are $100,000 versus about $56,000. So I would ask this client and anyone I work with, well, which has a better cash flow? $955 a month to a bill or $950 a month? This next case I'm going to highlight a little bit with a little bit more detail because this one was a fun case. So she had $135,000, which is not bad for law school, that she borrowed. And over 10 years of payments, including interest, it would have been $187,000 total at $1,561 a month. Standard loan repayment for 10 years. Remember, the goal for the old plans is to pay the balance in full. So now that you're aware of student loan forgiveness, you might Google it and you may find other companies out there. I call them my competition, but they're not. I don't say that to brag. They just don't do as thorough a job that I do. And those of us that are board certified in this system, we just call these people document preparers, because literally if you go on their website, you will see that they say they are a document preparation company. That means they do not provide financial education. They neglect the tax consequences. The worst part, I think, is they charge you based on your perceived savings. Now, what do I mean by that? Well, if this attorney went to them and tried to do this 20-year repayment plan, they would have said, hey, look, we saved you $1,561 a month. That's $18,000 a year we saved you, and we charged you 25% of what we saved you. That'll be $4,500, which sounds cool because she saved $18,000, but this is the reality. The very next year, her loan payments jump to $752. Over the full 20 years, $204,996 plus income tax on the forgiven portion on $99,000. So add another $40,000 to that bill. And why did this fail so bad? Well, let me show you. This is what happens when you do it wrong. So the $0 payment, that's easy. She didn't work while she was a senior or a junior, so that really doesn't count. There was no income to report. So of course you're gonna get $0 a month. The next year, she started her job. She has a $41,000 income, adjusted gross, and then she also got married. Her spouse has $75,000. So that is why the payment jumped. A couple other things which affect repayment. Remember, having children also affects it. This one actually affects it in a positive way. Payments go down here, $30 a month. And then more kids lower it a little bit more. But the bottom line with this is if you do this wrong, you could have some very costly things to make up for. So this is what I do. This is what happens when you do this right. So again, she did not work while in school, $0. I don't take any credit for that. But her first year salary, same thing. Her and her husband, she's only paying $127 a month. That's way better than $750, and even way, way better than $1,561 a month. And it gets even better because when they have the first child, it drops to $77 a month. She skips a year. She has another child, $29 a month. And when they have their third child, they pay $0 for the next 5 years. Now, is this an extreme example? Well, no. People get married and have 3 kids all the time. The numbers look really good. That's probably what makes it sound extreme, but really people get married and have kids. And there was only one way you could have gotten this result, and that's the way, if you plan with taxes, just the way I do things. I don't look at the first year or two. I look at the entire picture, the whole 20 years or the 25 years. This is the whole program in full. And if you do the math, instead of paying $187,000, she's only paying $8,160. And don't forget about that 1099. She's got income tax on this $300,000. The loan grew, but if you're only going to pay about 40% of it, you let it grow a little bit. So when you do the math on this, the competition would have done this. She would have paid, remember, $204,000 plus that income tax on $100,000, which is $244,000. Or if she does my suggestion, she'd only pay $8,000 plus the $121 in income tax, which totals $130,000. Now remember, the traditional payment plan, and this is only 10 years, was $187,000. So where does cash value life insurance fit? Well, to show you how it fits, let's just go back to some numbers. Remember, the standard plan over 10 years, she would have paid $1,561 a month. The proposed plan, an average of $34 a month. And we know she has income tax. Remember that. So when you put that in the future, 20 years in the future, we know we have a goal. And we were able to lower a payment from $1,561 down to $34, which means we're going to use some of that recaptured money to save for taxes. Now, if she were going to stuff this money under her mattress for 20 years, I would suggest $600 a month. So with no interest over 20 years, that would be $144,000. But we're smarter than that. We have access to interest. So what if she put her money $600 a month at somewhere that had an average of 5% interest? Well, that would be $247,648. I mean, why not? You have 20 years. We have vehicles that can get way above 5%. So why not? So that is how you leverage student debt into life insurance. I'm going to go back to this attorney's example. So we're starting her off with $128,000 in student debt. Now there's hope, because if she qualifies, which she did, then we're going to take $600 a month at 5% interest. Now this is an estimate because it's based on life insurance performance, health, age, cost of insurance. And if you're using IUL, it varies, but 5% is modest. So we have 20 years of this at $247,000 growth. When her loan gets forgiven in 20 years, we policy loan $121,000 for the tax, and her net cash is $125,758. That is essentially, if you look at this, and if you've been taking screen captures this whole time, this is the one you really want. If you look at this closely, or even at a distance, conceptually, she pretty much just got a free education. Or you can say she flipped her $128,000 in debt into cash. Doesn't matter. It's less money out of pocket. So if this attorney was somebody else's prospect, Remember, she has a gross income of $41,000 and discretionary income, which is subtracting all of the necessary expenses just to live in poverty. She would have ended up with a monthly discretionary income of about $2,000. Now, yes, she did get married and has 2 additional kids. So this one I just calculated on 1 child. Now remember, she has that student loan payment of $1,561. So is she going to be able to afford that payment and life insurance? And let's say that agent was able to get her life insurance. There's a chance that it could get canceled within a year or 2, or maybe not, but there's that risk. Now, if we work together, if this were your client, well, I lower the student payment. And because we're doing student loans, I know there's going to be taxes. So I recommend $600 a month for this particular case based on her circumstances. And for her at 27, a non-tobacco standard option B, the target premium ended up being $4,098. Now, this is not a fixed structure of the policy. That's just one of the examples that was run. So now, wouldn't it be a shame, though, on year 18, if she had a critical illness and needed to pull out money for living benefits? Yes, let's hope she survives to year 2021, but she still needs money for taxes, which is why we write a second policy for living benefits to protect the cash value on this original policy, so she is protected from the IRS. Now, as a team, this is how it would look. If your prospect has student loans, well, I'll recapture some money. Then I'll explain the need, the 1099-C, and because of these tax consequences, that policy will get sold on that alone. They have to. And then you write policies structured based on the amount recaptured, and then we split 50-50 on both policies because, well, splitting half on a big policy is better than getting 100% of zero. So this is your target market. There's 45 million student borrowers, $1.5 trillion that we can roll into cash value insurance, and 70% of the people that graduate are in debt. So you already know people we can help. You just got to ask the right questions. This is something you can ask in addition to if they already have life insurance. Great. Just ask them, hey, do you also have student loans? And if they already have a payment lowered, just ask them, hey, how are you going to handle the taxes on that thing? They probably are not aware of that. That ends everything. Was it Elke or Mona? Did you have any questions, comments that you wanted to address right now?
11:30.
So go ahead, Elke. You have a question? Go ahead. Elke, are you saying anything, or should I ask a question?
So no, yeah. So I have a quick question. So first of all, guys, that's a great sales pitch on how you. So basically, Carl sells the policies for us. That's really the message that we want to give. On one hand, it opens up a new market. So this is how I use it. I sometimes don't even talk to people about life insurance. If I'm talking to somebody who I kind of like feel could potentially be not open to life insurance, that we all know because we write life insurance, that label is sometimes a little difficult to overcome. Then I just basically say, hey, do you know somebody who wants to get rid of some student loans? This is a casual conversation that you can have with somebody, and then they say yes or no, or maybe they say, oh yeah, so-and-so. Whether they do something or not, it opens a conversation, right? It's sometimes a nice conversation starter that maybe lead directly to a life insurance conversation, or again, student loans. If it's student loans, obviously, I pass them on to Carl, I make the connection, and then he takes it from there. He sells my clients on the life insurance concept for me. They just come back to me, and then I write the policy. The question that I have for you, Carl, is this. When you project these numbers 10, 20 years in advance, and this is probably a stupid question from somebody who doesn't have a student loan, but how do you, so if you're factoring in, hey, maybe 2, 3 years down the road, you may have a child or another one, or maybe a divorce or whatnot, So what if this changes? How do the numbers change? Can you adjust your projection, or how does this work? Do you need to adjust it? Do you know what I mean?
Yes, yes. So during the initial information gathering, we find out what their goals are.
Yeah.
If they, let's say they have an unexpected child, then I'll just redo the math. Now, the reason that's important is because, yes, it'll lower the monthly payments. But by doing that, it will also raise your tax liability at the end when the loan is forgiven. So I want to make sure they're more than prepared for the taxes at the end.
Okay, so but when they have an event happening, they don't necessarily have to call you every time. So you kind of like cushion that a little bit. Is that what you're saying? So that they have more money basically through the policy than what they would need? Okay.
Yeah, I'd rather them overfund just because it's safer that way.
Okay. Okay. Thank you. Anyone else? Guys, you can unmute yourselves if you're on the laptop. I just figured that out.
Hi, this is Steve. I had a question. So their payment amount is a moving target depending on life circumstances. Is that correct?
Well, they definitely, so my primary concern is that enough is getting put away and growing for their IRS bill. We can always overfund for any other circumstance. I just suggest.
Sure. No, I'm not talking about the policy. I'm talking about the payment that they are required to make to repay their loan and whatever arrangement you work for them. So that depending on when they have a child, they have a second child, they have a third child, that will automatically lower their payment, or is that, how does that work, Carl?
So it depends. So the first thing is, well, their income. It's income driven. The number of dependents, the state they live. If they can actually file wrong, which is like an example I gave, but those are factors that if you know how to do it, you can put them either in your favor or not in your favor.
Right. I understand that for the initial calculations. I'm saying as life continues in subsequent years, they have a child, do they have to reapply at that time to get their payment changed, or how does that work?
So the IRS will, so when they renew every year, remember how they can disqualify themselves?
Oh, okay. I don't remember anything about that. Sorry, I missed that portion.
Okay. So then I'll just review it then. If they make too much money, they disqualify themselves, and they know that the Department of Education, because every year they have to recertify their income, and at the same time they're recertifying dependents, or they pretty much link to the IRS when they do that. So it adjusts with them, and remember, just report it in your favor, which is what I help them do. So does that answer your question, or does it need a little bit more?
Yeah, I think so. So if I understand correctly, they have to recertify every year. And at that time, the IRS is going to tell them, well, if you want to, you can lower your payment, or your payments increase because your law practice is doing very well. You're making a lot of money. Your payments are going to increase to X. This is something the IRS automatically does for them, correct?
No, the IRS just reports to the Department of Education how you filed, if you made, how much your income was for that year, how many kids you had.
Okay.
The Department of Education, actually the loan servicer, based on what the Department of Education's rules are, will adjust based on what you sent to the IRS.
Okay. So there's another department that will tell them your payments went up or your payments went down should you choose to lower them. Is that correct? Somebody's telling them.
Yes, the Department of Education and their loan servicer. They typically give you at least 2 months notice.
Okay, so there is a loan servicer involved that who they're making their payments to, that are going to regurgitate the information coming from the Department of Education as to what they're qualified for now.
Yes.
Okay.
Yes, and as long as you don't make too much money or don't adjust it down, then you will stay in the program, which is the whole goal. Write out the clock of 20 years or 25 years.
Right, because the income, I mean, I understand their parameters for qualifying, so on and so forth. The first person I was able to engage in conversations is, I have a friend, but she probably makes too much money. I had no way to address that with her other than to say, well, get her in to talk to Carl. But do you have any great, very, very generalistic guidelines on that?
So I would say if they are a W-2 employee, there are a few things we can do to adjust pre-tax dollars. If they have their own business, there's a lot more flexibility with that. So if they are self-employed, let's find out what that probably means when they say probably makes too much money, because there's so much versatility with that status.
I understand.
Okay, we got about 5 minutes left. Anyone else have pressing question?
This is Mona. My question was that going down the same path of making too much money, how would it work? Say somebody started off making 40,000, then they were making 300,000. What are the scenarios that you've seen where people have been denied what you're trying to do? Are there any scenarios that don't work for you?
So if they're an employee and they make 300 grand, that one's really tough to work with because there are fewer options of adjusting their gross income down. When you mentioned someone making 40 grand going to 300 grand, that sounded like an entrepreneur. So there are things like incorporating, putting income in a separate entity, all of which are, valuable tools. So it all depends on what the client is. Are they a W-2 or a business owner? If they're a business owner or self-employed, there's a lot of options for them, the self-employed. Did that answer your question?
Yeah,
Hello, Carl?
I'm just trying to figure out what are the people, clients have come to you who have not been income-based?
I missed part of that question. Can you repeat it?
That you have not been able to help them? They're making too much money, or are there any other scenarios that we're missing out?
So the first way to qualify is that the student loan has to be federal. And that's what the majority of the loans are, they're federal. And then the second one is, well, they cannot still be in school. And the third one, they just can't make too much money. And that's still relative to how much their loans are, how many kids they have. So it's hard for me to give a definite no to someone.
Okay. All right. Fair enough.
I have a question.
Yes.
Hi, Carl. My name's Renee. So are you consolidating the loans through direct loans for them under the income base? Is that what you're doing?
No. Consolidating still means you got to pay the whole loan off. All you're doing is simplifying payments. That could be an option.
I'm just trying to have a clear understanding of how that's working. I've been collecting defaulted student loans for the United States Department of Education for the last 21 years. So I have like a lot of questions for you. So if the loan's already been consolidated or in default and already previously rehabilitated, can you still help them?
Yes. So if they're in default, we can rehab them. And if they've already been rehabbed, as long as they're federal loans and they're not in school and they don't make too much money, we can still get them. You can't consolidate repeatedly because
I know that, and you can't rehabilitate if they rehabilitate after 2008. So if they've already previously rehabilitated and consolidated, how can you help them? I guess that's what I'm trying to figure out.
So it's still based, as long as they're they qualify for the federal loan, and it sounds like it would be, as long as they don't make too much money, we're not actually doing another consolidation or another rehabilitation. We're putting them in a program on their income. So yes, we could still help them.
But who's the servicer? I guess that's my question. How do you do that?
Well, there's a bunch of servicers, Great Lakes, Mohila, Navient. So it's...
Okay, so you're sending it back to a guarantor if it's already with the Department of Ed. That's what I'm trying to figure out. I just don't want to be trying to sell something to someone that I don't have a clear understanding.
Okay, yeah. So we go back with the loan servicer, whichever one it is. and apply these.
Okay.
programs.
Okay, gotcha.
All right, you got another.
Carl, this is Steve again.
Hi there.
I do have another question. Okay, on the referral, as I understand the referral process we're going to make once we identify a potential client for us, that we will send them to your website and they contact you via the website. Is that correct?
Yeah, they can go there, read up on how it works, and then there's a button to book an appointment.
Right.
I always ask
Got
them
that.
to review, just so I can try.
So once somebody comes to you, how do we stay in the loop?
Well, one, I ask them what it is, and then two, you're going to be you are the initial contact, so sort of like.
But do we let you know that hey, we got a client we're expecting to come to you? Or how does that work?
Yeah, you can do that as well. Just so there's two ways of tracking people.
So and could you give us your contact information?
Yeah, I'll send it to Elke, and Elke can send it to everyone else.
Okay, yeah, that'd be great.
All right, so it
That'd
looks
be
like
great.
we are out of time. All righty, thank you everyone
Absolutely.
who could make it.
Thanks, guys. And then we'll send the emails out to everybody, okay?